Jonas Stalling. You gave us an appetizer, which was Northern Star. You followed it up with a wonderful main meal that was Fortescue. And now you've come out with dessert. Evolution Mining. You've done the history on the mining companies that have defined our last decade or 2 decades. And what have they done? They've gone from nothing to something incredibly substantial. Evolution is your focus today.
Mate, a $22 billion business. Can you just wrap your head around that number for a moment? And the last sort of 6 to 12 months make that number look pretty astounding. But this is a 15-year story, bit by bit, trading their way up, stepping stones, as they like to call it, going from asset to asset, from frankly not the best assets in the world to some pretty stunning assets. And even more remarkable, it has been a journey led by a guy called an accidental miner by himself, Jake Klein, and a very entrepreneurial team. So I've been itching to do this episode for a long time. We've sort of heard along the way about deals like the Ernest Henry deal that they did, which was just remarkable, like awesome stuff. And we analyse a lot of deals here. We talk a lot about deal making in the mining space. So why not learn from some of the best in the business?
I can't wait, mate. I mean, the feedback that we've had from the amount of work and research that you've put into studying both Northern Star and Fortescue has been extraordinary. And I know that today's no exception. In fact, I actually think you've probably done more research into evolution than any of the two. But
I'm keen to get it done.
You're building. And again, the characters are important. Again, the company's strategy is important. Fortescue, a story of execution. Northern Star, a story of deals and execution. But this one, a story of deals, right?
Totally. This is all about the deals. And to put it in the context as well, right, because there are cycles. We're in a very cyclical business, and there are multiple cycles in the company we're going to analyse today. We're clearly at one of the higher ebbs of the gold cycle today, and Evolution is a company that's had a drawdown of over 80% in its time. So I think it's really important as commodity investors as well to try and take this on board and understand what can happen when the cycle kind of turns. And I think Jake Klein would be the first person to say something like that. There's a couple other reasons to do an episode like this as well. Speaking of Jake, he has just moved to non-exec chair, so it feels like a bit of a passing of the guard there. And you remember in the Northern Star episode, we kind of brought that one to a close kind of when Bill moved on. So I think that changing in the nature of the business makes sense. And just to touch on that point once more that you made, it's all about the deals here. This is the ultimate investor/capital allocator mining company. And I think it's so fascinating. It's not just the deals that they did, it's the assets that they sold along the way, not just the buys, as well as the assets they, passed on. And perhaps most important, the timing of those deals. And, you can only kind of think back about it years afterwards, but when you do look back on Evolution, the timing's been pretty good, hasn't it?
It's been great to have commodity tailwinds. It makes or breaks a mining company, there's no doubt. I'm extremely excited for your story on the evolution of evolution. JD, where does the evolution of evolution begin?
Mate, we're going to kick this one off in the 90s. So I want to give a brief bit of background on two individuals. Firstly, Jake Klein and then Nick Curtis. So Jake Klein, South African born, joined Macquarie in late 1991. He was in his late 20s at that point in time, joins the internal audit division. And he moves through the bank, gets a flavour for all the divisions that a much younger and smaller Macquarie has at that point in time. But he gets a bit of a flavour for gold working in the bullion division. And they were doing a whole bunch of fascinating things, which I'll sort of try not to digress into. But he meets Nick Curtis there. Nick had first tried his hand as an art dealer of all things, and he is running the most profitable division of the bank, the bullion division. And to flash forward a bit for people that don't know, Nick would found Linus later on in the early to mid 2000s, and he would lead that company, as well as serving on the board with Evolution and playing a big role in Sino Gold, which we're going to get into. But they get their first taste for China pretty early on. It's the mid kind of 1990s here, and they are actually approached by a Chinese SOE, and Jake is tasked with showing this guy, Zhu Hangjing, around the bank for a couple of weeks in Macquarie's office in Sydney. Nick had already met this guy and he spoke super, super highly of him. He said he was one of the most interesting men he'd come across in a long, long time. And Zhu becomes very influential in the Sino Gold story, as we'll touch on later on. But he helps open doors and give local insight to the company and helps them on their kind of way.
This is the mid-90s. Like what is the political atmosphere of China at the time? Were they trying to incentivize foreign investment into China?
That they were in small parts. I mean, the opening up had really started in the late 70s with Deng Xiaoping, and that had taken a long time because China was extremely poor, and it's still very poor at this point in time in the 90s. But as these guys kind of show, they are pretty adept at reading the tea leaves, and they're going to China 10 years before others are kind of doing that. But more importantly, from China's perspective, they want to learn. And that is why they sought out Macquarie, because they wanted to learn about deal making and all sorts of kind of things, hence sending Zhu over to China and then inviting the Aussie team back to China. And they get an experience going to a whole bunch of different mines in kind of in the northwest of China, in some provinces that back in those days took a long, long time to get to. And over the Sino Gold and firstly the Macquarie journey, they were seeing firsthand how things were changing on the ground in China. Jake gave some awesome sort of anecdotes about how long it would take to get to places, and roll forward a few years that the trippers, dropped 20, 30, 40, 50% in time because highways are being built across valleys and all these sorts of things, which is just remarkable to kind of think about.
So Nick and Jake are invited to China, and what does that experience evolve into?
So eventually Macquarie learns that they're not going to get the fees that they want to get from the Chinese.
I'm laughing. Anyone that's worked in investment banking will have a good laugh at that. So.
Yeah, no surprises there. So in that sort of second part of the 90s, they leave Macquarie. A SOE essentially puts money into an offshore vehicle, a Cayman vehicle called Sino Mining International. And this is run from Sydney. It starts with $30 million US. And they look for a whole bunch of different things. They pick up alumina assets. They pick up undeveloped gold projects. They pick up developed gold projects. So they pick up a whole collection of assets. And then around the year 2000, the Chinese premier puts the foot down and says, we are reforming all the SOEs. A lot of these assets get pushed back out to the provinces, but it leaves Sino Mining International in a bit of limbo. Sino gets swooped up by a company called Minmetals. Might be familiar to a lot of people because they're the parent company of MMG today, one of the biggest businesses in China, mining businesses.
And Minmetals is an enormous commodity trader, right?
Yes, they're a behemoth in China still to this day. But long story short, for 18 months, they don't have a shareholder. So they get swooped up and they end up negotiating to take on this unprofitable gold mine. That's called Jiangchaling, plus a few undeveloped projects. Jinfeng was one of them, which would go on to become a mine and the second biggest gold mine in China. The Chinese state still owns a stake in that entity, Sino, and sooner or later, come 2002, we get a public listing. So the company, Sino Mining, lists on the ASX. The Chinese interest in that is way, way down. They raise $100 million. This is sort of cornerstoned by 4 investors taking $10 million stakes. And you got Jake as CEO, Nick Curtis chair. Later on, Jim Askew becomes chair in 2005. And if we fast forward all the way to 2009, they're a company with 2 mines. A third one is on the way. One of them is, like I said, the second biggest gold mine in China. These guys are the largest foreign gold miner in China, dual listed Hong Kong and on the ASX. And that is getting to the end of their 15-odd year journey in China.
You fast forwarded 7 years of Sino Gold's life there, mate, but those 7 years would have been filled with some pretty important lessons.
There would have been a bunch of important lessons, but the one that sticks out to me that they take forward, and this is a lesson actually I think they learned at Macquarie, this was hammered into the guys at Macquarie, is that you need to understand what your competitive advantage is. You need to know what your edge is. And In China, that was abundantly clear for these guys, at least early on. Costs were a fraction of what they were in Australia. These guys brought in the expertise of the Australian mining industry, and they brought that to an underexplored area. Like the average gold mine in China at the time was doing less than 20,000 ounces. And despite that, it was the biggest gold producer in the world. There was so much for the Chinese to learn, and the Chinese did a great job learning that. Everything is done in a joint venture. The Chinese, they would never give Sino or any other foreigner access to their tier one mines. They're working with the lower kind of quality mines. And a lot of what these guys brought to China is still embedded, as I've sort of read it, to this day in the Chinese mining culture, if you like.
I remember Jake sharing an anecdote. I think it was when we had him on the podcast about, like, you know, one of the operations, it wasn't ingrained into the operators to effectively, like, just do your development level by level. They would do all of the development and then start stoping.
And they're like, we're 12 years ahead,
yes,
something like that.
Yeah, which it's kind of, you know, we chuckle about it now because your latter point is so important. The Chinese did a phenomenal job at learning. In fact, like the innovations, the technology advancements and everything in the mining industry today, we're learning from China now.
Yeah, it's remarkable. I mean, what you first say there, that's straight out of the USSR. Like, it's a complete shift in how they think about these things. And yeah, where we are today is worlds away from that. But 2009, these guys knew the opportunity wouldn't remain forever, and the writing was kind of on the wall. Specifically, I'm talking about how the Chinese viewed foreign ownership of mines. And there was a few kind of hair-raising incidents that start to happen. And they make a call, and this is where Zhu Hongjing, who'd been, you know, running BD and done a bunch of things for the company, he really gave the advice to Jake, who did well in heeding it, saying things are changing here on the ground in China, and it's time to go. And for that, you need to find someone to buy you. And for that, they found Eldorado. So Gold Fields had been a big shareholder in Sino Gold, but for a bunch of kind of reasons, South African companies weren't trading at rich multiples. Aussies were kind of middle of the pack, and at that time, the North Americans were trading at much richer valuations. So Eldorado buys that 20% stake in the company from Gold Fields, and a month after, we have a deal, Aussie $2.2 billion to buy out Sino Gold.
At this point, Sino Gold, they were an ASX 100 company or 200? 100?
They were an ASX 100 company,
So it's kind of remarkable that, yeah, Sino Gold had grown from, again, very, very humble beginnings into an ASX 100 company at the time. Was taken out by Eldorado. From what like I'd heard about that deal around the fringes, was Eldorado were the type of company that thought that they had specializations working in, you know, exotic locations, and as Evolution read the writing on the wall to get out of China, Eldorado foolishly went in.
maybe a bit too exotic. Yeah, you're dead right. They'd operated in Turkey and, you know, a bunch of countries of that sort of similar ilk. But yeah, by 2018, they don't own any of the assets anymore. I mean, they got a bit of money for it, but not what they paid for. To think about it all, like, there's not too many foreigners that go to China and make a bunch of money and sort of just walk away kind of like that. You know, it's fascinating to think about. And more broadly, the 1995 period to the 2010 period, I mean, that captures the whole Fortescue story. That would have been, like, outstanding to just witness what was happening in China. That would have been one of the most fascinating times in modern history that I can kind of think of, to see the development of a country and see the hundreds of millions of people sort of come out of poverty. But that's a bit of a digression from the evolution story we're going to get into. Which
brings us to the evolution chapter, the beginning of evolution. I mean, you wrap up the Sino story. Jake's looking for a new job.
He is. They've sold themselves out of a job. Now, this is 2010 we're in. Jake is 45 years old and hunting.
Doesn't look it, does he?
Looking good. He's hunting for the next challenge. And as the story kind of goes, I think this one's pretty well told. There's a Sydney broker, Richard Granger. He sort of yells at Jake from over the street and tells him he's got this great opportunity to show him. That opportunity is called Conquest. Project-wise, they've got the Mount Carlton project up in North Queensland, and that had a DFS on the way, or arguably already kind of done. So Jake took it on to review the project with with his sort of connections, Aaron Colleran, Tommy McKeith, Ross Jenkins, a few other individuals that sort of pop up consistently throughout the story and are kind of pivotal in it.
Some of those characters had been involved with Jake in the Sino Gold story as well, right?
Yeah, exactly. And after this period of diligence, Aaron gives the advice that, he wasn't totally convinced by the project, but they sort of differed sort of slightly on the opportunity that was at hand, because Jake saw the cash box that the company was. $58 million in cash is a key asset that the company did have, regardless of what you thought of Mount Carlton at the time. And at its sort of lower ebb, that was an enterprise value of $25-ish million.
So the company's cashed up, but it's got an uneconomic study on it. Why was it uneconomic?
So the project is a refractory gold, silver, copper project. It's a high sulfidation epithermal deposit, as a lot of those ones tend to be in that neck of the woods. So a bit different to the gold mines that we have out here in Western Australia. But what appealed to them, if anything, was that the similarities they saw with this asset and that first mine that I mentioned in China. And as that sort of relates to why the feasibility could be improved upon, they thought they could cut a portion of the capex and sell a concentrate. So if you simple it down, that is what they were looking to do, and they thought they could sell that concentrate to the contacts that they built in their time in China.
So the study says that concentrate's not saleable. You need to build extra capex to actually refine this con.
Yeah, I mean that is what the study had just assumed they were going to go all the way down, and I mean later they backtrack and they start looking at that.
But these guys know that the con is saleable because of their experience in China dealing with these smelters.
Exactly, selling sort of 2% arsenic concentrates in parts of China there. So Jake is actually mentioned before he comes into the company in one of the releases, and the board commissions him to run this review.
Hang on, so the company puts out a release saying Jake Klein is running a review.
Yes. So we're in Feb 2010. Jake has come in to do this review. The stock has halved on the back of this, and Jake is using the expertise of him and his team to look at what they can do with this. And in March, another announcement comes out. Also worth noting as well that Goldfields was on the register here too, through a kind of weird confluence of events. They were the major shareholder and a JV partner in the land surrounding Mount Carlton. The CEO of Conquest had reportedly held sort of stock through Opus Prime, which was a kind of awful bankruptcy that happened here in Australia in 2008. One way or another, the stock gets put up for tender, and Goldfields get their hands on roughly 20% of the company. By the time Jake's there, it's 15% of the company. And the Conquest Goldfields relationship had soured quite a bit as well.
Isn't that interesting?
But Tommy McKeith is a common link there as well, because he had worked at Goldfields and he would be Jake had got to know him from that time, Sino Goldfields, and he joins the board and has a long relationship with Evolution. So
gotcha. So at this point, Jake's looking into the economics, but the market thinks this is a dud because they've told the market it's a dud. Meanwhile, the stock's now trading. What is it about cash backing?
It's a bit over cash backing,
right?
But it's a long way down from what it was. And essentially, the team from Sydney flies over to Perth to tell them the facts, what they think. And when I say the team, I'm talking about Jake as well as Nick Curtis and Jim Askew, who are brought onto the board in March of 2010. And shortly after that as well, you've got Aaron Colleran, Ross Jenkins, Dave Hewitt, and Charles Wang, three of whom had worked at Sino, joining the team in quick succession. And to the board's credit, they didn't fight it massively. They knew it was flawed in its current sort of shape and form, and the company was going nowhere, and this was ultimately better for shareholders.
So what did they convinced the board to just effectively change management, let Jake and the crew run this company?
Honestly, I know it's like West Perth. I had to scratch my head a bunch of times to wrap my head around the fact they would just walk away, but having spoken with a number of people, that is more or less how things played out.
Isn't that fascinating? You just a
win for shareholders.
You don't get such a polite happy to hand over the keys dynamic these days. But there was also an opportunity in doing that. I mean,
Totally. And the stock rebounds a little bit. It sort of trades in that 30 cents kind of range for a while. It's a bit of a far cry from 10 years later where you'd see the likes of Bill and Rao jump into a company and the stock price would more than double the next day. But the company had a lot to kind of work through here, but they get to it pretty quickly, and we start to see the strategy, which becomes the evolution strategy in time, which never really wavers from its sort of core roots.
Before that, interesting you mention team from Sino coming with Jake. Like that's a difference to the story of Twiggy, Anaconda. I mean, it was kind of gold to gold, so I can understand the parallels, whereas before you're going from Complex Met, which was Anaconda, to simple logistics, Fortescue, so maybe there's those parallels. But I do think it speaks volumes to type of individual when people that they'd worked with previously will go along for the next ride.
Couldn't agree more, and it's something we've seen again with Federation / Endura. It's a trend that just continues.
Are there carryover people at Federation?
At least 5 that I can count already.
Wow.
Yeah. No, it's a pretty glowing kind of statement, if you like, that you would do it not once, not twice, but maybe even 3 times in some cases with someone. So yeah, that rings loud and clear in this story. And the strategy is something else that is super important and crystal clear from pretty early on. They outline that there is a dearth of Aussie mid-cap companies, with 75% of Australian gold production being owned by foreign companies, and that they want to build a mid-cap with a portfolio of Australian assets at this point in time. And the reason they say like mid-cap or mid-tier quite specifically is that the mid-tiers are the ones that outperform. They outperform juniors and they outperform the major mining companies. And we're going to continue to speak through this strategy during the story.
The strategy is... this is, again, another reflection I feel like we'll get to at the end, but Evolution, just one of those companies, they said what they were going to do from the beginning, they articulated it, and the strategy was consistent. They achieved it, right?
Totally. But before we get there, mate, we've got a deal to talk about. In less than 8 weeks from that takeover of the company, you've got a very, very juicy deal, a $58 million deal to buy North Queensland Metals. So $20 million in cash, the rest in paper. Now, NQM, they were the 60% owners and the operators of the Pajingo gold mine, a pretty old mine up near Charters Towers. It was doing about 50,000 ounces at the time. And for context, the gold price is $1,400. So they have won over the major shareholder, a guy called Don Walker here, who's also a director. So it's a 3-person board. They've won over one director and a 20% shareholder of the company. Now, North Queensland Metals has also purchased the old Twin Hills mine in the area, so they're talking up this being a satellite operation, but really they're running this as a bit of a cash cow. And despite having a third of the board on side, the North Queensland board say no, thank you, your offer's inadequate. And by July, so a month after, these guys have a fight in their hands because this other little company called Heemskirk, who owns the other 40% of the mine, have come in with a competing offer, which was colourfully described as a toilet paper bid to us. So Conquest come out and say, that's clearly inferior. It's got no cash. The buyer has con notes in its structure. The premium is not really what it seems if you back out the actual numbers, and you don't even have major shareholder support. But in any case, they up their offer and they sort of amend the conditionality of their offer.
Pesky interlopers getting in the way, but I think it shows the difference when you do a friendly deal versus a hostile one. Your probability of success is so much more enhanced. These guys had the major shareholder on side, and then you get the pesky interloper getting in the mix. Well, you don't really want to do a deal with a pesky person, do you?
Well, it takes a while. So Heemskirk, as they would, continue to maintain that their offer is superior, and North Queensland agree. They encourage shareholders to reject the Conquest offer. So lo and behold, the takeovers panel gets involved. Conquest just sort of calling out a bunch of the strategies that Heemskirk were using. But by September, Conquest have solved it. They go and buy Heemskirk, and then shortly after that, they gobble up North Queensland with the major shareholders caving kind of in quick succession there. People like Acorn and Line Selection were involved in this one.
They had to buy Heemskirk in order to... Oh,
$37 million to buy Heemskirk.
Oh,
27 in cash.
That's juicy.
Yeah. So
that's juicy.
Hard fought M&A battle that took a good few months to chew through is done and dusted. And they're a mining company now. Like they have a producing asset. I think internally the team would debate whether it was all worth it for Pachingo, not the greatest mine in the world, but they're well on their way. You know, they've got Mount Carlton that they're working through, doing the optimizations and whatnot. And this 50,000 ounce producing asset is on its way to do 70,000 ounces the next year.
Pachingo, while it might not have been the world's best asset, it maybe gave them sufficient scale to do subsequent deals, right?
Yeah, totally. And this is a kind of frothy environment in the gold space. Back end of 2010 into 2011 that we're talking about now. So deals, cheap deals aren't throwing themselves at you. You have to kind of get creative, and you have to keep developing the development project you have, Mount Carlton. So whilst this deal is going on, they secure this concentrate offtake, and I love this. So they get this, they get interest from a bunch of Chinese smelters, as we sort of hinted at before, given the team's previous experience. And Ross Jenkins, who's the Met, and Charles Wang, I think, are the people that deserve a bunch of credit for their expertise and the can-do attitude here. So the story is that Charles just flew with a bunch of buckets with him on the airline, full of concentrate, to try and sell it. Just goes to a bunch of the smelters in the area in China, and one way or another comes back with a deal phenomenally. And this is firmed up in time to a quote unquote $1 billion offtake agreement with Shandong Guoda. They are a large gold smelter in China, and it's for the life of mine offtake for the V2 deposit, one of the two key deposits at Mount Carlton. And yeah, decent payment terms, kind of. You get 90% of the payments being made prior to the shipment going over, which is, in terms of working capital, a decent thing. The alternative can be pretty gnarly. And
can't understate just how wild this is, by the way. This was in a period of time when all you could really get out of China was a non-binding MOU of some description, and that's intertwined in the Fortescue story that you told. But Charles goes over there armed with an effective. It was the type of offtake agreement that I think Rio Tinto used. They had some lawyer who it was the same template thing, and managed to get signatures on it from Chinese smelter.
Just phenomenal.
Remarkable. A binding offtake comes back with,
company, yeah.
After taking on the plane some concentrate. I don't know about the disclosure of the material.
Don't worry about it. Don't worry about it.
It's truly, it's wicked.
That sort of entrepreneurialism I just love. And simultaneous to that, they keep working on the optimization studies. They're sort of focusing on the recovery, the grind size, trying to assess whether they can use a coarser grind. They're sort of thinking maybe not 75 microns, maybe 106 microns will still do the job. So reducing OPEX and CAPEX at the same time. They also buy a mill secondhand from Hillgrove, Kanmantoo in South Australia, about $7-ish million for that one. So things are happening for the company, and it's late 2010, and I'll just give a bit of a recap to make sure we're all on the same page about what this kind of company looks like. So they have a run up in the share price near the back end of that year.
Still called Conquest, by the way, not even Evolution.
Yep, still called Conquest. They do a $45 million placement. So after that, the market cap is about 270 million, 230 EV. They've all but confirmed ownership of Pachingo. They're sort of mining these very, very narrow veins down there. And the stock is trading in the mid kind of 30 cent range. A year ago, all this team had still been in China. That's all still been, well, not all, but the majority of them had still been running a predominantly Chinese mining company. So they've now done this tough takeover battle. They got their work cut out for them in an asset in Mount Carlton, and they're running this junior in a kind of frothy Aussie gold environment. So a big change in a year.
Huge change. That placement, that $45 million, was that to fund the development of Mount Carlton, or did that come later? It was just a staged raise.
So not too far down the road, they would raise another bunch of money in the next deal that we're going to talk about, and that deal would be ultimately 18 odd months a bit more than 18 months before Mount Carlton starts producing. At that time, the debt financing is coming together as well. So it's not quite fully funded to do Mount Carlton just yet.
I follow. What is the actual landscape of gold producers like on the ASX at this point in time?
It's a good question, actually, because that plays into the strategy. The strategy that they spoke to so often is that, you've got Newcrest on the one hand, a big company, and then you've kind of got this dearth. So they circle out the 750 million to a bit over $1 billion range. And, I mean, it's fascinating to read about the companies at this point in time. You've got Perseus, Medusa, Kingsgate, CGA, Avoca, St. Barbara, Oceana. So some kind of familiar names there, but a lot has changed kind of since that point in time. But there is a bit of a dearth in that mid-cap space. Now, granted, some of these companies are still big. We're coming to the tail end of a 10-year bull market in the gold price, and things are going to change quite soon here.
I am intrigued looking at that list of peers. Hey, it's
fascinating.
I mean, some of them disappear from deals, some of them merge, some of them implode from poor operations.
Some implode and come back.
That's a staggering slide.
It is.
What happens to Mount Carlton?
So the refined numbers that they come up with when they rework the CapEx and all these sorts of things is about 130 CapEx, and the MPV is only a bit higher than that for a 12-year mine life. The cash flows, if you sort of flush through the spot price, are, they give you a bit more room for encouragement. But the company's got $40 million, and like I sort of said, it's sorting out the debt funding at this point in time. We're talking April, May, into June of 2011, but then we've got a big deal that preoccupies the company for a little while.
This deal needs context, mate, because when I think of a deal that epitomizes the formation of Evolution, I don't even think of the backstory you've told to date. I think of this deal, just the absurdity of this coming together.
Yeah, you've taken a good while to actually get to Evolution, but this is the creation of Evolution itself, and it is a fascinating deal, right? So June 2011, Conquest agree this all-scrip deal with Catalpa, whilst concurrently buying Cowal and Mount Rawdon from Newcrest. So if you can wrap your head all around that, they're also going to do a capital raising, a $150 million capital raising at the same point in time.
So two companies merging with each other to acquire these non-core assets from Newcrest.
Which
everything's
they're going to pay for
in
stock.
And a placement.
Yeah.
It's gnarly.
So Newcrest is going to become the roughly 1/3 owner of this joint company, which they dub Evolution. Now, the pro forma market cap, $1.2 billion. EV is about $1 billion. And, like you've kind of said, these guys pride themselves on handling deal complexity, but it almost feels as if you've gone out of your way to make this one more complicated than it needs to be. But as we get into, there's pretty good reason for this. If we look at the assets very quickly, Catalpa are bringing in Edna May, so 9-year mine life, 100,000 ounces per annum roughly. They're also bringing in a 30% interest in Cowal. I know I said Cowal before coming in from Newcrest. They are the other 70% owners of this one. That's doing about 100,000 ounces as well, but it's only got 5 years proven out. Then you've got Mount Rawdon, as I mentioned. That's going to do 90,000 ounces in due course. Single kind of open pit mine, 8 years left there. And then rounding out the assets, you've got Pajingo and Mount Carlton. Now, Mount Carlton is due to come online in about 18 months at this point in time. So 4 producing assets and a development project. If you look back a year, what the pro forma entity would have done, it would have been a bit under 300,000 ounces, but on the way up.
I feel like I've heard Jake tell the story of this deal, and it doesn't kind of come together necessarily just by pure desire to put the two companies together. It comes from the preemptive right that Catalpa had over the other 70% of Cowal.
Yeah, you got to make this deal happen. It's not going to fall on your lap. So Catalpa they weren't even single, at the time. They had to break off talks with St. Barbara, who they were reluctantly in talks with, who just, in the month prior proposed a merger with Catalpa. That wasn't really friendly at all. But that preemptive right is super, super important that you talk about. So The Conquest team had seen that Newcrest, led by Greg Robinson, had just acquired Lihir, which we've spoken about in a previous podcast, and they concluded that Cracow and Mount Rawdon couldn't be central to the plans of Newcrest going forward. So they make an approach. Newcrest are actually quite receptive to this. Now, you have that preemptive right. Newcrest had actually previously tried to sell Cracow.
So Evo's approach Newcrest directly.
That's right.
Right.
Yeah, Conquest. So to the CEO, Greg's frustration, CEO of Newcrest, this group called Catalpa had a preemptive right and they wouldn't let this one go. So he just pretty much said that you go create some sort of arrangement with them and we'll be happy to kind of do a deal. And as was relayed in other channels to us, the Evolution BD team gets in touch with the Newcrest team, got this great idea. Newcrest is sort of nodding along. They're, receptive. They're thinking, yeah, this is great. This, we've already thought of this, They're given the whole pitch, Evolution, on why it makes sense for you to offload these assets to us. And then they kind of get to the point. We've got a problem though, You've got this this preemptive right and Newcrest say, hang on, you've got a problem. You need to sort this out. And then it dawns on them, we do have a problem. So hence the complex deal. They need to
spell that out, right? So why are Evo saying you've got a problem, this preemptive right? Because they're actually pitching to buy Newcrest stake in Cracow first, and then Newcrest flips it on them and says, sort out the other side of the equation, and then it all solves itself.
Yep.
Preemptive right.
So Conquest get in touch with Catalpa, and lo and behold, we have the deal that we have. So it took a while to get there. As for the merger itself, that's a 50-50 merger that the two companies are doing. Conquest get a bit of a bump on their last close, and you have this 8-person board, as you tend to when these sort of companies come together. Laurie Conway joins the board because he's one of 2 Newcrest nominees. So, it'd be still a few years before Laurie becomes a full-time employee at Evolution. And that raising that I mentioned, the $150 million, that was a bit of a spanner in the works, and they needed a commitment from BlackRock and Baker Steel to get that one over the line.
This comes from the fact that, so Newcrest is feeling a bit of a squeeze after fumbling the footy with Lihir, so they're needing to shore up their own balance sheet, and they didn't want to become a big shareholder in a pro forma Evolution that was underfunded. So they, as I understand, it was pressure from Newcrest in the midst of this deal to actually ensure a placement happened concurrently with it all.
Yeah, they wanted confidence because financing had been one of the problems to a deal getting done previously to a sale of an asset. So they wanted confidence that there wasn't going to be any problems on that front.
And that they were adequately funded, so they didn't get a call up for a pro rata share of capital down the track as well.
Yeah, they weren't having problems with Lihir just yet. This is the gold price is still very strong in 2011.
Right.
So it's yet to sort of fall through.
Right.
But they have refocused on Africa and PNG and the like. So they don't need these assets that made up 4% of their kind of value. So
gotcha.
Hence they're keen to get that one done. But yeah, it left a deal, that was already complicated being even more complicated for the Evolution team to do.
This is a gnarly deal still. You just don't see deals like this today. It's the coordination required to bring all of these disparate parties together, aligned on value and seeing the upside of what could be created, as opposed to getting kind of caught up in the weeds of a bid-ask spread in the moment, backing a management team in to lead things forward from there. It's pretty cool. It's a very cool deal. This is one of those deals that stands out when you study mining deals that A, because of what it created, Evolution, and B, it's just gnarly.
No better way to put it. It's super, super gnarly. And yeah, I mean, they do a few more creative deals, but nothing as kind of mind-bending as this one. But they are now once this deal is bedded down, a multi-asset mining company with a pretty decent-sized market cap. They're a decent-sized business coming out of this one in 2011. They sort out the financing for Mount Carlton. They can, in pretty short order, turn that one into more, commercial type funding rather than it being a project financing, because they have the spread of assets to get that one done, and the terms sort of come in. They're guiding to 350,000 ounces at this point in time. It's not long after the deal that the MD and exec chair role gets combined under Jake. They march on into the ASX 200, and whilst everything sort of is seemingly going great, the floor falls out of the gold price. From mid-2012, it would be 4 years until the share price breaks even again. 4 years is a long time when you're running a company. It's a long time when you've just financed a new mine. We've got a 10-year gold bull market that has just fallen through, and you've just put together this fantastic big kind of deal. But also, on the positive side, it would create the opportunities that built the company we know today.
Was there debt involved in their cap structure at this point in time?
There sure was, yeah. So for a number of years from this, call it 2012 to 2015, early 2015, they're in a net debt position of $100 to $150 million.
And that was to fund Mount Carlton, yeah.
That was funding Mount Carlton, yeah.
Yeah.
So, like I said, the gold price fell away, but you don't get these forced sellers straight away. It takes time, and a lot of patience is kind of required. Evolutions have to do a $385 million write-down in 2013 first.
Wow.
Which is never a good thing for shareholders to swallow. They're never too eager to see that. And they start stripping costs out of the business, out the corporate office. Numerous contracts close. They go owner-operator at Krakow. They flatten the org structure. By 2013, late 2013, the merger's almost 2 years in the rearview mirror. And like your comment on the balance sheet just there, it's not as healthy as it kind of could be, a bit over $100 million in net debt. The share price, looking back just 12 months, is negative 57%. And that only puts the middle of the pack when you look around the field of what the other goldies have done. But they still actually pay a dividend at this point in time. Believe it or not, they pay a 1 cent dividend, which, might not sound like the biggest thing in the world, but they have remained super dedicated, and that, instills capital discipline, paying a dividend every half year. I think they're going on 25 or 26 dividends now paid. That is kind of remarkable to do it at this point in time. Their
production is confronting when you just look at it. Like 427,000 ounces in FY14. Like that is a formidable production profile, but they
don't make money.
they're not washing their face.
No.
No one's doing well, but they've got the production and they just need the commodity tailwinds.
They do. They're a leverage play without doubt at this point in time. That's a big number for a company not to make money, and they know more than most that the assets aren't the best in the world that they have. But it has been a very tough year going around, and I say not making money from a kind of cash flow perspective. They had been bringing on Mount Carlton, online through this period as well. But the real concern is that reserves are depleting. These assets don't have massive mine lives. Like Jake would later always talk about having an 8-year plus mine life on your projects across the portfolio. Pajingo, these sorts of assets, they don't have that. And they need to get on the stepping stones to get to the better assets at this point in time. On the positive side again, the forced sellers at this point in time are starting to emerge. We're now mid-2014, looking around the field, Northern Star's done some of their deals. They've done 3 sort of around the New Year period coming into 2014. So you're starting to see transactions that reshape the Australian gold landscape for a long time to come.
One of those forced sellers becomes Newcrest of their Evolution stock over time, or does that happen later?
That happens in 2015. So before we get there, as these things tend to be, the stock price continues to bomb out. Late 2014, shares trade below 50 cents, so the market cap is south of 400 million. When that merger was done, I said $1.2 billion. So the company's fallen a long way from that, and so has everyone else in the arena.
They probably raised nearly more capital than that at that point in time.
I know, right? So, these things sort of grip the markets and these kind of trends. And the trend here is profitability, and they don't have too much profitability to show. So they're talking about reusing mill bores. They're talking about smarter drill and blasting. They're talking about going owner operator at every site they can. They're talking about pulling in employee turnover. You go through the slide decks of companies at the time, and more than half is just cost-saving initiatives. Like, you're really tightening the belt here, and it starts to work in bits and pieces at Evolution. They start to make a bit of money quarter after quarter, and then they get hit with, the Queensland floods, a lot of their assets up in Queensland. So they're copping it from all sides, and it's very, quick and easy to say in retrospect, but when you're living through it, I can only sort of imagine when it's kind of year after year and you're copping it and you're just waiting for the times to turn. But like you say, we have the Newcrest sell down. Their 32% stake, they sell in two parts. So they sell at the beginning of 2015, and then at the end of at the end-ish of 2015, or in the second half, they take a big haircut on that compared to what the value was when the deal was done. And it's a very unhelpful time for the company for this to happen. And, when something like that happens at that point in time, you kind of might question Evolution. History shows that they were just trying to look after themselves. And, I don't think it would have taken a genius at the time to realise Newcrest themselves needed the cash. It wasn't a fundamental flaw at Evolution.
Isn't it a staggering kind of reflection that a 32% shareholder at the formation of what we know today to be Evolution lost money? Like, that's crazy.
It really is crazy. And like all the same, it's a trend you see with some of these phenomenal success stories in any industry. There are multi-year periods where the company doesn't go up. The stock doesn't just go up linearly. Like, you need to bear through the bad times to enjoy the good times. So yeah, it is kind of funny to take out a 4-year piece in time, and they took a big haircut. That it's kind of remarkable. To round out on the personnel side of things, you've got more familiar names. I know we spoke about this before, but Cobb Johnson and Tommy McKeith, they joined through that 2014 period, and Jake has finally worn down Laurie, who joins the company full-time, becomes the CFO in 2014. So again, familiar faces showing up throughout this story.
This entire time, Jake is exec chair as well, right? Like
MD and exec chair.
MD and exec chair. Yeah.
So interesting.
Controls the company and the board.
Yeah.
Yeah.
Interesting and no accident as well. Yeah. So coming into 2015, there's a bit of health in the Aussie gold price, which is good for Evolution, obviously. And they make a bit of a voluntary pay down of debt. And then come April 2015, we have the first real kind of bear market deal, which is a cracker.
This is the period where like Evo's assets actually start making good money, right? They've got like 3 core mines that all make about $100 million in that 1 year each.
Yeah, that would be the next year more so. Like going from 2015 to 16, you think, hey, these projects can actually make a bit of money when the gold price ticks up a good few $100, and sentiment changes like it always does. But they need to get through a couple deals actually, but before they get there.
Gotcha.
So the La Mancha deal.
Juicy. Super
juicy. I know you've actually studied this one a little bit, and we've spoken with La Mancha in the past, a couple of years ago now. But La Mancha is a private mining investment vehicle for the super wealthy Egyptian Sawiris family, so Naguib predominantly. And they owned Frog's Legs, it's an underground mine, White Foil open pit mine, and the brand new Mungari mill, 1.5 million tonne per annum mill, which had just been built 1 year prior.
Naguib was an Egyptian billionaire who made his fortune in the telecommunications industry, and
from a very wealthy family.
Somehow got the gold bug and found himself owning these mines in Kalgoorlie.
Yeah, and all through Africa as well, which would become a focus later on for him. But he's got these assets in the East Kalgoorlie region, and they want to find someone to really help them grow. They want a vehicle to kind of put this in so that somebody can kind of do the growing for them in a way. And that ends up being Evolution. So Evo's pay for this deal in scrip. La Mancha ends up being a 31% shareholder. And at this point in time, Newcrest has sold their first half of their block, doing the other half later. Evos actually have to take on $115 million in net debt at this point in time. But we're back to $1 billion market cap with this share issue. And super importantly, La Mancha, Naguib, commits $100 million to future growth. The assets themselves have done 150,000 ounces at a bit under $1,000 all-in sustaining cost. So that's a more than 10% improvement on the all-in sustaining cost of the asset portfolio that the company had at that point in time.
Evolution's just had the overhang of a 30-ish% shareholder who's reducing their stake and a bit of an overhang on the share price. They finally see out Newcrest, and now they welcome another 31% shareholder. There's a bit of an anecdote on how they agreed that 31%. Because you're trying to figure out like what pro forma, like what are they bringing to the table versus yours, and isn't there an article in the AFR about how they exactly landed on 31?
There is. So, I mean, some of the stories are very funny, but one of the details we heard is that a half a percentage point difference is negotiated via sort of screaming matches in the office, and it's a kind of arbitrary number. They're negotiating it head to head on a kind of like for like basis, where they say, you use reserves or this much, reserves, we'll use this much percentage of reserves, you use a bit of resources, yada, yada, yada. And at the end of the day, they knuckle down and they come to an agreement. And like you do in Sydney, you go to Rockpool to celebrate that one and drink it all away in expensive champagne with the Frenchman from La Mancha. But yeah, it was an expensive kind of deal to get done, but a super important deal in the stepping stones of evolution and their kind of journey. There was another detail actually which I want to mention because I find so fascinating. Evolution didn't even use investment bankers for this deal at all. Led through Aaron Colleran and Kieran Schmidt there as well. The BD team that they had internally just sort of powered through this one, which is a pretty cool little detail.
That's a common theme, and especially I think this year is chock-a-block with deals. You don't you can't actually get that many deals done if you have like teams and teams of advisors, because they slow you down. You're not nimble enough. You add complexity. There's more meetings in the calendar. You're talking about things that don't actually matter. But if you back yourself, your own capability to do what's required, it is possible to do 3 deals in a month, which they did.
Totally. And that comes down to the MO of the company, deal making. If that's your expertise, you got to be able to do it in-house, don't you?
I say it's possible, but it's still genuinely, truly impressive. Having worked in banking, mate, I've been crushed from just one, one on the plate, absolutely crushed. And the fact there were 3 enormous ones simultaneously is stupidly impressive.
Yeah, totally. So if we analyze this deal for a moment before we jump on to the next one, the assets are better. You're paying a big price for it, but you're pulling down your all-in sustaining cost. You're providing more cash generation. You're pushing out the average mine life of your portfolio. Doing it with cash, that wasn't an option here, given the strategy that Naguib and La Mancha had. The gold price, like we've always sort of said, rises throughout, so you get kind of nitpicky deciding who's a winner. But at the end of the day, both the sides here are winners. They had equity upside in this, and both would do very well in due course. I think the Evolution team at the time, and perhaps some of the shareholders out there, didn't weight how important that La Mancha alliance would be, that $100 million, which we're going to talk about, because having that support you through the next deal kind of means you need to take both deals into account at the same time, because you can't do, the other one wouldn't have got done. And the other deal we're talking about is Cowal.
Huge. And
that is a phenomenal deal, a remarkable asset to scoop up from a major. And yeah, in an environment where gold prices are down a long way from what they would have been many years ago. So let's talk about that deal, mate.
Cowal is the cash cow.
It is.
Cash cow.
It is. And it wasn't so apparently clear at the time, even shortly after the deal. There was criticism about this deal. A lot of people saying, "Oh, you've overpaid for this one," and that is clearly not been the case.
This was a sale process, right? And only the actual announcement of the deal only comes a month after the Mancha deal's announced. But these things are kind of in the works, contemporaneously.
Yeah, absolutely. And the same day that IGO bought Sirius, and
Wow,
the
two big deals on the same day.
two big deals on the same day, and IGO, or Independence Group as they were called at the time, were rumoured to be hunting around looking at Cowal as well.
I mean, they were a gold miner before Sirius, so it totally
Yep.
makes sense that they were in and about that sale process.
So they're buying Cowal for US $550 million from Barrick. Undoubtedly better asset and bigger price tag. With stamp duty, we're talking about 750 million Aussie dollars. That is bigger than their market cap. This is a big deal for the company at the time. Cowal's doing about 250,000 ounces, an all-in sustaining cost over 15% lower than the portfolio. For those that aren't familiar with the asset, sort of big at the time, sort of open cut project in kind of central New South Wales, 7.5 million tonne per annum mill. So it's a large scale, lower grade gold mine, and the mine life of the project at the time was only out till 2024. We're in 2015, so it's not a long mine life, and there's I think about 800,000 ounces sitting on the stockpile. So mining was actually going to stop in 2020 roughly, and they were just going to process the stockpiles for the few years after that, which is the downside of the massive upside if you can prove it out and prove that there is a longer life here.
Well, there's a difference between limited mine life because mineralization actually ends, and then there's these type of assets which have much longer mine lives than you're paying for in reserves at any point in time because you do another cutback or the likes, and you've got mineralization extending at depth.
Let's underline that. Let's pull that forward right now from one of the talking points later on. Optionality and mine life are underrated in NPV studies. This asset is now going to live on till 2042. It is doing over 300,000 ounces per annum, and it's doing it at an all-in sustaining cost of, I think, about 1,400 Aussie. The optionality really rings true when commodity prices shoot through the roof like they do every so often. It's not a common thing, but that is a point in time we're living at right now. And had you sort of modelled at the time, 2024, you're not getting that 2025 fantastic gold price. But now the amount of money it's going to make this year is going to outdo many of those years put together, right? And that is something that Jake would say. That is something that a lot of the smart investors in our arena have sort of said for a while. That optionality is underrated, and we see it more and more with the people that think super long term about deal making in the resource space.
It's a true this is an asset that really just transforms the company. This is this is a tier one asset. I know it's not 500,000 ounces, but big reliable production profile, long life, low cost. It's
tier one jurisdiction,
far better than everything else in their portfolio up until this point in time.
And it moves Evolution to be on ounces, which is not how they'd look at it, but the second largest producer in Australia. Decent bit of debt they've brought on board to get this deal done.
How did this deal get done?
Mate, this is a great story. So, like you mentioned, competitive process. Goldfields, Zijin, they were rumoured to be in and around it. The Fin wrote after the deal that an insider told Jake it would be a Bradbury if they won. So for non-Aussies, you have to search that one up on YouTube. But when Street Talk came out and wrote about the deal in the months prior, you've also got Northern Star, Independence, like I mentioned, Regis, Oz Minerals in and around the hoop there. But the pieces fell into place very late here. So essentially before the Friday when the bids are due, there is a board meeting and there's a lot of fretting about the price. Is it, 485? Is it 500? Is it 525 that we're going to have to pay? And they're wanting a bit of guidance from, perhaps the senior people within the board. And as we kind of heard, it was Jim Askew who inverted the question. And a great insight here is that how do you feel, or what would be the outcome if we didn't win this? And that kind of sick feeling in their stomach at the thought of losing out by $15, $20 million is what spurred them on. And they actually bid an extra $50 million on what they'd previously planned. So they go from 500 to 550 million. These numbers are 10 years old, but that's how it's sort of remembered.
When you're confronted with, well, what does my portfolio look like if I don't have this? And there's some harsh realities about that, then it actually encouraged them to pay what was considered overs, right?
Yeah. And what's $50 million if it goes right? Hey? So on the Saturday, Barrick give Evos the call, say, let's catch up Sunday. And they're worried. Jake's worried. They're thinking they might get the treatment. Oh, the other guys are in the room over there. The other ones are just over there. And this is an open auction now. What's your best? You're close, but what's your best offer? But lo and behold, the asset was theirs. $550 million, got it done. And, we've said it a bunch of times, but this is a undoubted portfolio improver. They would always show this great chart, simple but great, that effectively shows the margin on your y-axis, the mine life on your x-axis, and things are going up and to the right, which is always a kind of good sign. But in the months afterwards, Jake is seriously concerned that he materially overpaid. People are
There's
saying
criticism. There's the analysts are saying that they've overpaid. I mean, you run an NPV at consensus gold price. They overpaid.
And to your point on the analysts, we heard a great quip. The analysts don't know what to value the thing at. You just tell them what the asset is worth.
It's worth what you paid.
Made me chuckle. You mentioned something earlier as well, Trav, which I think is super important with the context of the asset and how it had kind of been treated. There were quality ideas within the people on site, but Barrick hadn't been investing for three long years. They hadn't really been investing in the asset. So the group that ran the asset there, which would be coming on to Evolution, they had ideas. They had stuff they wanted to do. They had leads they wanted to chase up, And on the back of that, the asset goes from having 1.6 million ounces to nearly doubling in less than a year. Like, they're just given the capital to chase up these things. More recently, like I said, out to 2042. So they've been sort of kicking goal after goal there. And it's kind of remarkable. If you'd gone into the $250 million raise that they did to get this deal done, which the La Mancha group took half of, you would have compounded your money at 30% per annum. And I know that's a bit skewed by the last 6 or so months, but that is a great return on a long time period, 10 years since that deal was done, more than 10 years since that deal was done. And this is also, looking at all the deals they have done, this is the one that management most commonly cites. This is the go-to deal, the asset that stood head and shoulders above the other ones. And yeah, I mean, we're looking at a mine that analysts call roughly $6 billion of net asset value within the portfolio today. That's pretty remarkable.
But it goes to net asset value of $6 billion today versus, well, it would have been US 500 back then, thanks to mine life extensions, but also thanks to gold price, bull market. That makes these deals look phenomenal. You can't understate the fact that the gold price has been a huge tailwind for Evolution's growth.
100%. It's been a phenomenal tailwind. And I want to talk a little bit about this talk that Jake gave. He gave it a bit after the time period. He gave it in 2016 at the Melbourne Mining Club. A phenomenal talk to listen to. On the gold price, it's really interesting because that speech, when the snippets he talks about the gold price could have been given today, talking about government debts around the world and all these sorts of things. It's very interesting. So it's not as if they didn't, I don't think they would have forecast the gold price being where it is today, but they knew the game they were playing. Beyond that, he spoke about the 5 attributes that make a top gold miner, and I want to highlight these because I thought it was such a stellar talk and understanding of what makes a good gold miner. So, point number 1, efficient, high-quality assets that operate at a low cost with at least one cornerstone asset. That cornerstone asset has the lowest quartile costs and a long mine life. 2, consistently discovering more ounces at your operations. 3, financially disciplined with strong, uncomplicated balance sheets. 4, having resilience based upon a strong people culture. And 5, investing smartly. And I like this for a bunch of reasons. Firstly, he's he's clearly studied the great gold mining companies that came before them. Like he would reference Randgold in the talk. He's previously mentioned Normandy and others, but he understands the history, the cyclicality of the business, and what makes a company, which I really kind of like.
Would have banked plenty of them at Macquarie in the bullion days, and yeah, I do think that's a reflection of Jake. Is like he's often been a big thinker about what creates great gold miners. I've seen that in more recent times when he would talk about, again tying it back to China, and he talks about he's talked thoroughly about it, both Agnico. He's talked about Zijin many times in the modern era.
Absolutely. So next up, to round out 2015, we've got a bidding war with, of all companies, Zijin over Phoenix Gold. They end up paying $50 million for the land around Mungari. And here's where the cash flow that you mentioned before kicks in, $400 million in net mine cash flow in FY16. They rapidly start paying down the debt. They had roughly $600 million and pay more than half down in 1 year. And if you look at the ounces they're doing, that rate that they're going at there, they produce less ounces today. So it goes to show that they've actually lived up to the ounces over margin kind of mantra and continued to tweak the portfolio on the way through. And coming into 2016, sentiment really shifts. All of a sudden, very quickly, goldies are out of the sin bin and they're in fuego again. People are loving them. The stock prices are jumping up. Evolution stock price more than doubles in a year, and they're well on their way. And that brings us to August of 2016, where they divest their first asset, Pajingo. They'd had it in the portfolio. We started the story just about there for 5 odd years, and it's time to offload the asset. They get $42 million for this one, but
they sell it to Mancha.
They sell it to Mancha. Yeah, I think it's really important to show because they've spoken about it for this. At this point in time, for over 5 years, you improve the portfolio quality by both divesting as well as investing. And now they're finally walking the walk on that one, and they've divested their first asset. And then the Ernest Henry deal. This is the deal that made me want to do this episode. This is an unbelievable deal. It's interesting for so many reasons, and I'm excited to rip into it. Just 1 week after the sale of Pajingo, in between which their full year results came out. And there was an interesting sort of...
whose full year results?
Evolutions.
Evolutions, okay.
There was an interesting interaction played through the media here where Jake said, we are continuing to look at deals. We are continually looking at deals. And one of the big shareholders, Alan Gray, just said, calm down, focus on your portfolio, but they didn't listen to that.
They were aggressive. They were aggressive at the right times.
$880 million purchase of an economic interest in Ernest Henry. This is
economic interest.
Economic interest.
What? This is just like anyone that's ever looked at an all-in sustaining cost or cost curve chart for Australian gold producers would just be scratching their head. Why is there this big block at the beginning that goes steeply negative? And it's always Ernest Henry, and you're like, what something doesn't produce at a negative all-in sustaining cost. Doesn't make any sense.
Yeah, maybe we'll clear that one up right now. For anyone that's gone this far that doesn't look at mining companies like we do, when you look at the revenues of a mine that produces multiple commodities, you take the byproduct, the lesser commodity, if you like, and you subtract it from the costs. So the all-in sustaining cost can look remarkable, and Evolution understood this. No accident here. They understood what the marketing of gold miner looks like. They understood what generalist investors will look at when they come into the space, tier one assets, in Australia, very low cost, all these things. They got it, and Ernest Henry just checked a lot of those boxes. But I had to pay $900 million if you take into account the transaction costs. And obviously they're going to pay 30% of the future costs for this economic interest. They would be getting all of the gold produced here and 30% of the copper and silver within that life of mine area, which was to a sort of certain RL. They would do a roughly $400 million entitlement offer at over $2. So like I said, more than a doubling of the share price from when they did the Cowal raise. They also
partially debt funding and equity then.
$500 million term loan to get this one done as well.
Yep.
And a preemptive right, another preemptive right. They get the
for the rest
preemptive
of it.
right
Yeah.
in this case.
Nice.
So-
The vendor, mate, Glencore. Now, why is this like an important and interesting point? Because Glencore's got a reputation for always having the hooks in deals that they do. They kind of always have one over, or they sneak something in there. But this is a tremendous deal because Evolution got the last laugh, and they've done a great deal, and they did that deal with Glencore.
Totally. So, I mean, why do Evolution want this? Obviously, there's the marketing that we've spoken about, but Ernest Henry is also a decent scale, long life copper gold project with plenty of growth potential. It's had plenty of capital invested in it, so it's not going to be super capital hungry. They also had Mark Lemessier, the COO at Evolution, who knew the asset inside out. He'd worked there, and they knew with that preemptive right, they'd be in the box seat to collect it down the track. And they had a forced seller. They knew, I mean, Glencore had gone and said, we are deleveraging. We are in a lot of strife. Everyone knew it. And we are not wanting to sell copper units of production, but we want cash in the door. Hence, if you could come to them with a creative solution, they'd be willing to listen.
They were actively running sale processes in various parts of their portfolio. I mean, they were in a real pickle. People were writing articles about the demise of Glencore and the likes. There was a lot of debt there, and they had to deliver imminently ahead of their own reporting period dates.
Yeah. So a quick sort of synopsis of the sales process is that in late 2015, they kick off a sales process for CSA in Cobar. They also start having a bit of interactions with Evolution on Ernest Henry, and they toy with the idea. But then it takes until about April until things start to look a bit more serious, because Evolution are still chewing down Cowal at that point in time. They are still chewing down the Mungari, assets there, and they've done that Phoenix takeover. But the bankers at RBC, they pitch this deal again in March, April 2016, this time as a joint venture. And come April, they sort of formulate a plan. End of that month, they present this plan to Glencore. And there's a bit of back and forth for some time. But it takes until July and August for things to really start to heat up, because that CSA sales process has crashed out. Glencore needs the cash. And by this point, late July, Evo's table a take it or leave it type of offer. And they've met with the Copper King, Teles Mistakidis, the one of the billionaires that came out of Glencore, very famous copper trader, and he's sort of running copper there. And they have an agreement in principle, essentially. $880 million is acceptable with a bunch of conditions, but we need this deal done by August 24, which is an outrageously quick turnaround time for a deal of this kind of complexity. I mean, they need to, amongst a whole bunch of other things, lock in bank financing. They need to get 5 banks to commit $100 million each for a deal they don't even have recourse over. They're not even going to own the asset. That is
It's an economic interest.
An economic interest, yeah. And on the Evolution side, they're also selling Pachinko at this point in time. They're doing their full year numbers as well. So it's a busy period. Glencore, to heap the stress on, have the sale process for Lomas Bayas fall through in early August as well. So they're becoming increasingly needy, and the deal starts to sort of happen. A lot of these processes in getting a deal done, which are meant to happen in a series, have to happen in parallel to get a deal done. To sort of emphasize the point, Glencore's share price is down nearly 70% from their IPO 5 odd years earlier. So they start caving on these conditions, like you say, that they're so famous for hooking into a deal. And lo and behold, on August 24th, the deal is announced. They went from, within about 4 months from just a concept to having a final binding deal with a company that many in the industry would call the best negotiators there are. Just remarkable.
I think it's wicked. I think there's a lot of reflections to be had on the actual deal structure and how it got to where it did, and what that actually like meant for the look of evolution, right? Because Evo's toyed the idea of, well, you're not willing to part with the copper, can we get the gold? And so then some back and forth is had with toying with the gold interest. But what actually ends up, you had to meet both parties' interests. So it was clearly critical for Evo's to get. They still got 30% of the copper interest as well, right? In a certain designated area. That copper, critically important to the all-in sustaining cost dynamic. You need to have a byproduct in order to offset your like to be netted off of the gold price, so that you can actually have a negative all-in sustaining cost. I don't think they thought it was going to be negative. I think they underestimated how much the copper would contribute here. So that was a positive surprise that it actually became a negative number, which seems absurd. But then on the other hand, the way it was accounted as well. So they structured the deal as an economic interest. It's equity accounted from day one. Now that further has implications for your all-in sustaining cost as well. It wasn't a coincidence the way that this deal was structured. It gave Evolution a completely unfair advantage in marketing themselves as a low-cost producer, albeit it was a facade. But
totally. To go on with the complexities you're talking about, you're going to share the numbers of a Glencore mine with the ATO? Like, hell no, you're not. Like, all that negotiation needs to take place in such a confined period of time.
It was conditional on FIRB. It was conditional on a whole bunch of stuff going on here.
Yeah, they needed to raise a lot of money to get this deal done, and just remarkable. What's your competitive advantage? Like we mentioned before, handling deal complexity. Check and check. They've done that phenomenally here. And this was also interesting because a lot of the gold assets in Australia had started to trade, at higher values. So finding a seller who the timing worked for, they had to be creative, like we just said, super, super creative in doing a deal here. To go back to your marketing point, all-in sustaining cost, by the next year, Evolution call themselves the lowest cost global mid and major mining company, gold mining company, the lowest cost. And Ernest Henry is a great contributor to that low cost.
Absolutely helps that you've got 100% of the gold and only 30% of the copper. Wow. What a remarkable asset to call a gold mine.
I could talk about that deal for hours, but we'll move on, mate. To fly over the next little period, again, they just hammer down the debt payments. They start with about 600 million and they pay off more than half again in the space of the 1 year sort of following this deal, call it 10 months with Ernest Henry integrated. They then sell Edna May, so another deal from the foundational merger. That's coming late in 2017. That sort of received several offers. No surprises here. Edna May was the lowest quality asset in the portfolio. Just look at this chart here. You can see the margins really struggling there. If you're listening into the podcast, the EBITDA margins across most of the assets are around 50%, and Edna May is below 20%. And as we heard from the team, we hated Edna May, so good to get that one off.
They sell it to Ramelius.
They sell it to Ramelius, paying up to 90 million, 40 million in cash up front. The other 50 is contingent and, perhaps marginally below what consensus thought the asset was worth, but these are relatively insignificant sums here, and good to get that one off because the portfolio improves again. The mine life goes up, the average all-in sustaining cost improves because it was a higher cost asset, and they are making their way on those stepping stones to being a company with a portfolio of assets that are much higher quality than they were just a few short years before.
Isn't it interesting? Edna May served as a great stepping stone for Ramelius too.
Now, we've got a period where they're scratching their heads a bit because there's not an abundance of opportunities out there. You don't have four sellers anymore. The gold price is starting to tick up. But operationally, the company is just checking the boxes. 7th year in a row, they achieve production guidance and cost guidance in FY18. And by 2019, about 3 years after the Ernest Henry deal, they're on the prowl again. Balance sheet very healthy. They are a $4.5 billion market cap company and growing. And just a quick one. In Feb of 2019, actually, they spin up a bit of an unusual one. They take a 20% stake in Tribune. Now, unfortunately, we don't talk about this one too much as I'd love to. But Tribune, of course, were the JV partners with Northern Star in the EK JV. This one sort of goes quiet for a while because they weren't able to get too far.
Yeah, I mean, it would later become very relevant again, but clearly the intentions are signalled that, of course, it makes sense for the ore at East Kundana to feed the Mungari mill, as opposed to what Northern Star were having to do, which is haul it much further.
It makes too much sense, but sometimes things take a little while to work out. But we've got a juicy deal before that, mate.
Before that, sorry, mate. Why did Northern Star not do the deal with La Mancha if the synergies are so obvious?
I've asked that to so many people, and nobody has told me the answer.
Yeah.
Maybe we should just give Northern Star a call.
Yeah.
Yeah, it just seems so obvious. And, I mean, it would, in another incarnation, happen down the track here, but not crystal clear to me why that deal didn't happen.
Are they preoccupied themselves? Yeah, I'm sure like La Mancha would have approached Northern Star. Having said that, like there was a view out there that that Evo's overpaid for, like there was a view that they paid too much. So maybe there's a value discrepancy.
Yeah.
Cool.
I mean, the price is very different to what Northern Star had done their deals for.
There's a bit of a chapter change for Evos in the next deal, mate, because they go overseas.
They go to Canada. So November 2019, they do a deal to buy Red Lake. Now, this is very different. So it ultimately becomes a expensive lesson that many Aussie goldies learnt the hard way in Canada. What they agree is, in Aussie dollar terms, a $570 million deal up front, including the fees, to Newmont Gold Corp, plus another $100 million US contingent. This is 100% debt funded. So they're buying Red Lake with a healthy balance sheet. So they take on the debt to do this like they've kind of done previously. No equity raise this time though. $600 million loan comes on board. And they label this as an asset with significant turnaround potential. Red Lake at the time, very historic asset. Mining since the 40s, over 25 million ounces had been produced in the area. The reserves were a bit below 3 million ounces. Within a year, that goes to 11 million ounces. Processing capacity, a bit over 1 million tonnes per annum there across two plants. Hadn't been operating anywhere near that for years. And even Evolution's plans weren't to get it to nameplate for the foreseeable. If you look at the kind of maps here, it's, there's a bunch of complexes. This is a, gold everywhere type of thing. There's an interconnected underground tram, very different to kind of what we mine here in Australia.
There's development everywhere. It's big, it's complicated, it's historic.
It is, and it's an asset that has not done well because, as Evo's put it, the 2016 to 2019 has been a period characterised by underinvestment. Underinvestment in development, in exploration, and that's going to need capital to fix it. But when it comes good, maybe it'll get to its glory days of 500,000 ounces per annum. They weren't saying that at the time, but they were very confident they could get it over their 200,000 ounce per annum transition target. And they also called it a beachhead in Canada. So there was an inkling to do a bit more.
The asset had all of the hallmarks of a good deal at the time, right? It's being sold by a major. It's an unloved, undercapitalized asset in the portfolio of a major. It's got big. It's got scale. It's got long life, etc., etc. So yeah. you could have wrapped a phenomenal story around this, and the market believed the story that Evolution told at the time that it announced the acquisition.
Yeah, the share price went from under $4 at the time of the deal, at the time the deal was announced, to over $6.50 in about half a year while the deal is getting finalised. And that's through the start of COVID, remember, and that's a tumultuous period for the gold price and for mining companies trying to operate in the other side of the planet, no less. But we'll jump a bit forward before we analyse this deal, because they do a bolt-on deal in March 2021. Now, they buy Battle North, not quite 18 months after the initial deal was announced. Canadian $343 million. So Evolution is a much bigger company at this point in time, but it's still a fair bit of cash to chalk up. Now, Battle North, they were the underbidder on Red Lake, actually, so it made sense to consolidate that area. Their flagship asset is the Bateman project. So that's got reserves of about 600,000 ounces and plenty of infrastructure there, a new mill, plenty of sunk capital had gone into that one as well. So it makes a whole bunch of sense to combine these assets, as you can see on the map. And Evo say combined, we're going to hit 350,000 ounces per annum.
So they're still telling the market in 2021 that this mine is going to be capable of substantial production. But what we know and reflect on today is that that Battle North, they're trying to maybe backfill the promises already, and Red Lake did not live up to the story that was initially told to the
No,
market.
it didn't, and it wasn't for the lack of capital being spent. I mean, they outlined a $500 million major capital plan pretty early on, but one of the big problems that it comes down to was a cultural type change. Their preconceived thoughts on the kind of change they could instigate at a personnel level just didn't match up with reality. Analysts around the battle time are still forecasting 400,000 ounces of production every year for over a decade, and at a pretty compelling all-in sustaining cost as well. So
This is another one of just tell the analysts what the value is, because I mean you're looking at Evo's share price and you've got to have a target price that's above where the share price is. So you've probably got to have some pretty rosy assumptions about this asset.
you do. For those wondering right now, what the guidance for the next year is from this point in time, so FY26, it's 140,000 ounces. So it's a long way off. Of course, margins is what really matters, and the asset did $74 million in cash flow in the financial year just gone.
That might have been the first financial year where
That was a record. The year before, it lost $115 million.
Yeah.
I mean, with investment, going into the ground. But Evo's, I love some of the charts that Evo's have shown throughout the years. They've shown some great ones from an investor's kind of perspective. And they would show this fantastic one, which they've kind of brought back in various incarnations, where they show how much an asset has paid back versus the acquisition cost and the amount of money that's sunk into it. Quite clearly, the ROI on Red Lake is nowhere near what it has been on other assets. But as is the case with all of these things, a flying gold price does help a lot. There was immediate skepticism, going back to the deal and the analysis of the deal and trying to think about, like, what did people think of at the time? What do they think of today? The North American shareholders were skeptical kind of from the beginning. And, perhaps they were the ones that had seen this asset a bit closer, because down here in Australia, we're pretty unfamiliar with the asset. Evo's targeted many areas of improvement, mining, processing, exploration. But again, to go back to that point, I think there was just an overestimation of their ability to affect a change and get the asset kind of humming again.
it can't just be a cultural, the reserve gets downgraded like consistently. In fact, even this year's reserve was downgraded by like 2 grams per ton. So like consistent reserve downgrades from, I know they upgraded it massively and like immediately after the deal, but their geological DD was clearly not reality as well.
Yeah, so to put numbers to that point, in the most recent numbers, they chalked off 4.5 million ounces from the resource. That's a staggering number. And the grade dropped from 7 grams per tonne to 4.5 grams per tonne. So that's the most recent R&R statement that we've seen. They are huge drops. So completely right. The ore body has not shaped up with what they'd kind of previously thought. And how they kind of frame that now, taking a fresh glance at what things are going to look like going forward, they just sort of say the asset needs to consistently deliver if it's to be worthy of any new capital going in. Whether it actually is, like, again, to compare what the analysts value this thing, is it a $2 or $3 billion NAV asset? Like, there's no way in hell I'd be paying anywhere near that for this asset. But, perhaps that's the opportunity. Like, the gold price we're in now affords it a lot of opportunity to make money.
It's a big endowment, there's no doubt, but a big, complex mine, and that comes with high high costs, and there's always the allure of spending more capital to make those costs come lower. But that more and more capital kind of keeps becoming more and more capital. I think they've learned. Well, they always know they're great capital allocators, but you're always competing for capital, to the most worthy parts of the business. And to your point, like, what is the return on capital to Red Lake versus the other assets when its return so far has been pretty de minimis.
I mean, it's no coincidence either that every Aussie Goldie went to Canada and struggled. Like, it's not as if there's not the gold there at every single one. There's a few too many cases in which that's happened for it to just be a fluke.
The relative value at that period of time was severe, right?
Yeah.
Like things were bid up to extreme over in Australia, and everything just looked cheap in Canada. So you thought, well, heck, I'm going to get outsized returns by going there, but it didn't quite work out. I sound like I'm very critical of this, but I think like on the whole, you have to evaluate Evos for the phenomenal like value creation story it is, and this is a blemish that they had to deal with.
Yeah, and if you go back to late 2019 again, and you look at this opportunity again, like. Yeah, I mean, I'd be curious to know what they'd say about that, whether they do the deal again, because it just looked so compelling. So if we keep going in between those two deals that I mentioned, firstly Red Lake and Battle North, they divest Cowal, another asset from early days, $60 million in the door up front with a total price tag of $125 million. So again, chalking off one of the weaker assets. And shortly after the Battle North deal, they wrap up the EKJV. So $400 million deal with Northern Star getting in 100% of Kundana, 51% of the EKJV, a bunch of other assets in the Eastern Goldfields kind of area, and they're elevating Mungari to a cornerstone asset in their portfolio. All cash deal. The edge or the competitive advantage here is pretty straightforward. Like you mentioned earlier, you can just chop that haulage distance down by nearly 90%. So it's super kind of compelling why this deal makes sense and why you can pay more for it than anyone else can, because the returns are going to be great. And they raise nearly $470 million to finance this deal. You can see again on the asset portfolio chart here that things are looking better. And that is a conservative chart because it doesn't show the margin improvement just yet that we'd see in time when they expand the asset. But a smart deal that just sort of makes sense, and the benefits that come from it far outweigh the cost of this one. The returns have been great, and add to that the expansion that they have done, kind of remarkably. They've done that 9 months before schedule and under budget as well. That was quoted to be a $230 million investment to get the asset over 200,000 ounces, and what a time to do that sort of expansion at. It's going to help the payback look very, very good for that asset.
I find that I think your reflections are right about this deal, but I do remember it at the time again. Now, their license to M&A, to do M&A, is a little bit in doubt. Now, this one, what did they do? I think at the time the gold price was much lower. I think they paid about like full NPV of like for Northern Star to be a willing seller and Evos to be a willing buyer. Northern Star thought they were getting a pretty good price, and I think Evos are effectively paying full NPV, including the synergies that they were benefiting from. So, yes, both parties win, but there was certainly, I remember conversations with peers thinking, man, Evos have paid top dollar for this. With the fullness of time and what gold price has done in the intermediate period, and the additional benefits they've had from the other East Cal assets, the mill expansion, etc. It looks a good deal, but I think this is a common theme with Evos is they don't always look a good deal on the outset. In fact, the one that looked a good deal on the outset, being Red Lake, turned out to be the dud.
Yeah, and I mean to think about the seller in this case. So Northern Star had just done the deal with Saracen as well, so they've become a much bigger company all of a sudden. This is clearly a lower quality asset in their portfolio, and like you say, with the upgrade in mind that you can unlock more value through it that way, yeah, they might be taking their pound of flesh for the synergies that you're going to experience as well. But I think time and time again that view that NPV is different to what most people might think it is, because, maybe they're curtailed by the reserves or whatever it might be, having that long-term time view. And I know it's hard because the gold price makes it look so good. But
it was necessary to make Mungari what they call a cornerstone asset.
exactly.
Right?
Their portfolio was improving on the back of this deal, and not just by a little margin.
They continue to rationalise non-core late life assets to improve the overall portfolio. They finally part ways with Mount Carlton after being a pretty important contributor for quite some time and having its hallmarks from the very early days.
It had its time, yeah. $90 million deal, 40 up front. They're getting for this one, selling it to Navarre. So a year before, Evolutions had to impair the asset by $100 million. So it had started to have a few problems, getting a bit creaky and old. And yeah, I mean, some assets had this one, some analysts rather had this as a negative NPV on the books. So good to get a bit of cash and, again, improve the asset, improve the portfolio by divesting. And then they consolidate Ernest Henry. So November 2021, a big deal again, $1 billion, $800 up front and $200 just being paid a year later. So the stock bounced 7% on the day. So the market liked this one quite early. And to finance this, they sign up US $200 million in debt at 3%. We're in the zero interest rate era here, so you can finance these things quite cheap. They end up going to a net debt position of $1.3 billion. And in time, you'd kind of see, because they go into a very heavy period of investment. So the balance sheet is a bit extended, but it always kind of extends once they do a deal because they tend to sign up that debt. But
this is the fruits of their labour from the first deal kind of coming to fruition, right?
Fruits of their labour, fruits of their, smarts to get this one done. Absolutely. We know they're not getting any more gold here because they're already taking all the gold. So they're getting 70% of the copper and the silver as well. So EVN's group all-in sustaining costs would improve by nearly $200 an ounce in 2 years' time.
Isn't this remarkable? I know the precedent had been set globally, and Newcrest was a leader in having a reported low all-in sustaining cost because they had like phenomenal kind of copper credits with several assets in their portfolio, Cadia being a big one of those. And I think, like, to your point on Jake studying the what made great gold miners, well, the unspoken rule that he didn't list in that speech is make sure you've got a low all-in sustaining cost because you've got copper credits. And it tricks people, it tricks journalists, it tricks not even just journalists but resource specialists who, I mean, the all-in sustaining costs, which was just adopted by the entire industry and popularized by the World Gold Council, it has its pitfalls, but when you just look at that and you try and think of, well, who's a low cost producer, you come up with Evos with these big copper credits, despite cash flow not necessarily being reflective of that.
The rules are the same for everyone. They're just using them to their advantage, I think. So we've touched on the preemptive rights, super important. They did the groundwork here. Still, it was a fairly steep price that they paid, but again, people analysing the deal at the time were a bit restrained in how they thought about this deal because of the relatively shorter reserve life that was left, which in due course, Evolution prove out and extend the mine life quite substantially.
This is a great asset.
This is a really, really great asset.
It's a truly great asset.
They've also, taken ownership. They're now the operator of this one, which is an important detail. You control your own destiny. By all accounts, the Glencore joint venture went relatively smoothly. But
it wasn't a JV, mate.
Wow.
Economic interest.
Economic interest, call it what you like. They, in time, validate that price, and financing things in that period, 3% debt, that's, we're getting to an era now today where interest rates are going down again, and we'll see what miners do with it, but very, very smart to get that over the line. So that wraps up the kind of history. Obviously, they do Northparkes, but that's too close to where we are today to analyse thoroughly. But,
well, I find that interesting too, Northparkes, because I remember doing a potty when they announced Northparkes, and you and I you and I doing, like the numbers and being like, oh my God, look at the crazy EBITDA multiple they've paid for this. They've overpaid, blah, blah, blah. The balance sheet was, looking a little bit shaky. They did a raise to fund part of it, I remember, and the share price quickly kind of dips to below what the raise price was in the months afterwards as markets looked a bit fragile. Gold as well. And we were critical. But again, like Northparkes has the hallmarks of it's a very long life asset, and in the fullness of time, if you have the commodity tailwinds, which we've been lucky enough to have over Evo's journey to date, then it just rubs over those facts, and the people who maybe like people like us who called Northparkes like paying too much at the time. I mean, I can totally imagine having the exact same reflection about our comments then as we've had about like certain deals that Evos have done, like historically as well, being Cowal, overpaying for Cowal. Did they overpay for Cowal? This is a common theme. Did they overpay for La Mancha? Did they overpay?
30+ year mine life, like you're going to get some very good years in that time.
If only didn't have just a crazy stream, but that's okay.
Yeah. I think you're spot on. So since the Ernest Henry deal, the EV of the company has gone from $6 billion to $22 billion. That is despite years of actually poor operational performance. They missed guidance on several occasions over the past few years, very heavy periods of capital investment, and again papered over by a phenomenal appreciation in the gold price. But where we are today, they are Australia's 25th largest public company, and Laurie Conway from Jan 23 became the CEO and managing director. Jake became just the exec chair at that point in time, and as of July of 2025, Jake is the non-exec chair. So I think that puts a wrap on the history.
It's a great history at that, like the evolution of evolution. And I know we're capturing it at a snapshot in time, but it's a tremendous growth story from deals and commodity tailwinds and like savviness and seeing opportunity where it isn't.
And for that reason, mate, we need to dive just quickly into their thinking behind deal making. So they have a 3-pillared approach to creating shareholder value: operations, discovery, and M&A. But as it was put to us, now this is a tongue-in-cheek comment, but I loved it nonetheless. Operations are where Evos tease shareholders about the prospect of creating value. Discovery is where they torture shareholders. And M&A is where they really create value. Now, that's the type of comment that could only come from the corporate team. And I think it actually speaks very highly to the culture, knowing the context in which that comment came internally there. But I think it's worth talking about. I mean, Evolution have proven themselves to be competent managers over the long run of the assets that they've gone. The geos on the discovery component have gone above and beyond replacing depletion, adding to the mine life of many of their assets. They've put themselves in the right postcodes to do that. That's coming from the M&A. So there's a whole bunch of things that are lining up there. Operations are kind of limited by your geology. You need to be playing in the right areas to have the work cut out easily enough for the operations team. That in turn, allows brownfields exploration to kind of be successful, and allows the geos to do their work effectively. And we've seen that in abundance at Cowal and Ernest Henry with the mine life extensions. But looking at the management team here, M&A is the culture. M&A is the focus. They are deal makers through and through.
They're deal makers, but thoughtful deal makers. They're not deal junkies, like where you are you do deals because you're just deal hungry. There's discipline to the deal making. It's knowing when to be like very aggressive and knowing when to be reserved. Like this isn't just a scattergun strategy where they got lucky. There was a deliberate strategy about knowing the time in the cycle to be aggressive and knowing the times to peel back. And like this was articulated from the very beginning. There was a deliberate decision about like having stepping stone assets, starting with a not so good portfolio, but using those assets to acquire better assets with longer life, lower costs over time. And they bootstrapped their way via not so good assets to having like a pretty formidable, like, portfolio.
Yeah, there was a comment that also really stuck out to me to add to what you've just said there. Jake said that people too often have inertia and they don't do deals because they think they're undervalued. That didn't hold them back because they did deals when their share price was in the gutter as well. They were proactive about doing deals. They were incredibly thoughtful about the deals that they did. And to put a bow kind of on what you've said about the timing of deals, there is a time to do deals and there's a time to make money, as they've always kind of said. And
why do you think Evolution didn't have the inertia that other companies might be plagued with?
I think that just comes down to the culture of the team. I think they had a culture within the corporate team that made them proactive about that. They wanted to be a mining company from day dot, and they just kind of got after it.
The fact Jake was exec chair, do you think that made a difference as well? Like, you've got a supportive board of being bold. There's not necessarily pushback from a board perspective because, like, you're exec chair.
There's phenomenal alignment.
Yeah, great alignment,
Yeah.
Great capital markets backing as well. Like, nothing was impossible to finance because you're dealing with someone and like a team which has done it before together.
No accidents either. Like, they nurture the relationship with having a major shareholder, which a lot of people would look as a negative, having someone sit on your register with 30+%. If we quickly look, there's this matrix I want to show in how they think about the deals. And I think it's a really cool one to understand, a bit of a guiding light in how they think about deals. And it differs for every company depending on your expertise, your size, your balance sheet, all these sorts of things. But essentially, for those listening, it's a kind of circle, and it has 10 different boxes to check, and you can kind of rate them when you think about a specific asset. We're talking about things like the mine life, the transaction complexity, social license, commodities, these sorts of things. And I think there's a couple points here that need inspection because they make transaction complexity look like something hard, but that is an edge for Evolution. Another one, if we're going to be nitpicky on commodities, I'd almost put copper gold above gold there in how they actually think about things. And then lastly, annual production there. Annual production, and Evolution have shown this, only matters so much as in like how much it impacts your margin. That's what really matters because some of their, like Ernest Henry, for instance, that's not, a massive gold producer. It produces a lot of copper as well, obviously, but margin is what really matters.
Which year did you first see this in their public materials?
In the late 2010s.
Wow.
Internally used before that. This one image. This is the Evolution playbook. Yeah, like your sweet spot is becoming a company full of assets that have that green circle. But the only way you get there is incrementally. On the deal making, there's one more fantastic slide we have to show. They break this out. I think they showed this one in 2017 or so, and they show that 17% of M&A deals add value. So if M&A is where you create value in your business and only 17% do, you have to be bloody good at doing deals.
Backed themselves, didn't they? The only thing I don't like about this slide, mate, is the source for that stat is management consultant KPMG. Now, talk about things that don't add value.
Can't argue that.
But these were deal makers. They back themselves to create value because some deals do create an enormous amount of value, but you have to pay an appropriate price and get the timing right in the cycle. And those things are very, very hard to do. And Evos did it, albeit with commodity tailwinds. But it didn't take a lack of this was a team in the right place at the right time with the right skills and the right amount of confidence, and they saw the opportunity. And what do I mean by that? No other mining team, in my opinion, I don't think could have enacted as nimbly as Evolution were to the opportunities in front of them, and been so thoughtful about even seeking the bilateral deals that they did do out. They minimally used advisors, like you mentioned. They trusted their own internal team, and so we're talking a small number of people to to take a view and deliver. Like these were rapid succession deals that were done, and it takes an enormous amount of effort to achieve that. And the only way, in my opinion, that you do achieve that is with the capability, like the confidence, and also not using advisors.
I couldn't agree more. And I think it's a great segue into what are the guiding principles to the evolution way. So firstly, the strategy. Jake would always say, I'm not convinced that gold companies are scalable. Hence, majors aren't the ones that create the best returns. So the strategy, Aussie mid-tier, 6 to 8 assets, 8-year plus mine lives, tier 1 jurisdictions. Improving the portfolio means investing as well as divesting, all these sorts of things. They just sort of ring true, and they didn't change from day one. Remarkable. That strategy has stayed the same.
He's consistently said that over the last decade plus. This is what we want to be. Well, we're now it.
Yeah.
And yeah.
Add to that, knowing your competitive advantage. You know, from the experience selling gold concentrate with Mount Carlton to the complex deal making, they knew their competitive advantage. Another part of the evolution way is marketing. We've joked about the marketing, but it works. It's effective, and the rules are the same, like I said, for everyone.
Do you think, just on the marketing, like not just marketing the all-in sustaining cost, like Evo's is such a popular name amongst the Sydney like generalist funds management community, even international, international investors being acquainted with. Do you think, and I know there's stories like parallel with Northern Star, but like you couldn't juxtapose two very different like leaders of those businesses in Bill and Jake. Like, Bill, the country guy who's like, experienced miner and speaks in speaks like a miner, and Jake, the polished like Macquarie banker. He's so like schmick, corporate flair, like, endorsed by maybe the fund manager community. Do you think there's anything about their images and like characteristics as people that also like, was a marketing advantage? Or do you think I'm reading too much into it?
No, I think you're 100% right. I mean, for one, it shows you there's multiple ways to get to a fantastic outcome, but there's no accidents. We've just spent hours looking about how thoughtful they are about everything. You think their appearance and reputation is an accident? Absolutely not.
I know you're a big believer that companies' culture is a reflection of their founders, and in the case of Jake, how do you think Evolution's culture is what it is as a result of?
We spoke about the dynamic of the team coming back on board. I think a little less spoken about dynamic is just like getting the job done. Like that shines through when we talk about doing all those deals in kind of quick succession, just a can-do attitude to get the job done in a very quick turnover time period, relying on everyone. You got Laurie doing the cultivating with the banks. You've got Aaron and Kieran doing the more kind of deal-making aspects. Jake would be doing the roadshow side of things. All those, and a whole bunch more people that we haven't met there, but there's that sort of accountability that rings through, and people having their responsibilities throughout the organisation and just delivering up to them.
They could make things happen and fill in the void to back solve just to get to the opportunity. That's a great trait of an organisation to lean into the complexity, even though it's harder work. But you need the just get it done attitude in order to get it done in the first place when it's hard.
Yeah, and it pays off. It pays off big time. If we rattle through the other kind of parts of the evolution way, making your people think like owners, like massive cliche, but they pay everyone with stock, and that's something that Macquarie did as well, that Jake experienced from when he was a young employee there. They buy from majors, and not just in the sense that people think about, you'll get a good deal out of a major, but majors put themselves in the areas, in the best positions geologically and otherwise. So that rings true as well. For all the deal making now, organic growth is best. So if you are in those great regions, the geos can find the prize brownfields wise. And lastly, they paid a dividend. They paid a dividend consistently because that forces capital discipline. It makes you think more about the dollars that you have and how competitively they need to be used and invested or returned to the owners of the business.
The alignment is striking in all three stories all three big value creation stories that you've told. And yeah, Evo's no different. Alignment makes such a difference.
100%. We have obviously spoken about how positive the gold price has been as well. And maybe just to add to that, you have the opportunity there for everyone, but it was there for everyone. The outcome is where execution meets opportunity. That leads to success, and that's what they did. So maybe for a moment we can sort of pat them on the back after saying the gold prices treated them so well. So some takeaways, mate. I'm kind of keen to hear some from you, what you kind of think and reflect on. But I'll start with a couple. As you mentioned before, the alignment. So Jake shaped that board, and in a different way to what we've seen with many other companies, with that exec chair role from very early on. And maybe if you're listening to this and thinking as somebody who wants to build a gold company or any sort of mining business or any business at all, for that matter in future, that is an interesting way to think about it, which is not the most common kind of route. Maybe it's different from a governance kind of perspective, but it's worth noting. I can't think enough about like how many of the people came back. Like that just sounds, that's just such a glowing endorsement to have people come back and do it. One company, maybe a second company, maybe sometimes even a third company together is just such a glowing recommendation that you sort of love working with the people, and it's a really cool thing to see.
That's not to be like, I think understated. We spend so much of our life with the people that we're working with. It's a big choice and it's a huge vote of confidence to, even though like it would have been at a substantial intensity, I'm sure, like to have the continuity of personnel, like that's huge.
A fun one to think about in the takeaways, the deals that didn't happen. So I'm just going to rattle a few off here, but the Super Pit with Newmont.
Before that, Jundee, like they were trying to be troublemakers when Northern Star were finalising, everything and had agreed something with Creasy. Evos were, I think it's public knowledge. They were really trying to put forward a more compelling deal for Creasy, and they were willing to pay more. But Creasy didn't renege on his word with Northern Star.
Another one that could have been Carosue Dam. This is an interesting one to reflect upon because they were fractionally the underbidder here in a deal that Saracen would win, and they were relieved that they didn't win this one, but that led to the emergence of a pretty mighty competitor in Saracen.
They were relieved because it reminded them of Edna May, and they already had Edna May, and they had a bunch of problems and issues, and they didn't want any more headaches similar to Edna May. But as it turns out, like not winning Carosue Dam, created Saracen. Like that's the gold landscape would look very different.
Sure would. Kingsgate as well. This is one we heard the presentation was even done, and I cannot verify at what point in time this happened, so I'm just going to leave it there. But Kingsgate and the Chattree mine in Thailand, that would have been different. That would have been so different. And then there was also Detour when they looked in Canada and they looked in North America for a long time. So Detour is another one that might have been.
Yeah. So there's like opportunity cost in the deals you didn't do. There's also opportunity cost, obviously, in the deals you did do. Do you think Red Lake is a deal that they shouldn't have done?
I think it's just too hard to say. If you're there at that point in time, your balance sheet is healthy, these things are trading super compellingly, and come at it from a finance kind of perspective. Oh, these guys have just underinvested. Oh, there's a lot of low-hanging fruit there. Sure, you think you can do it better. So
is the risk of like leaving your backyard so substantial and maybe underrated in some respects? Because I think Red Lake was announced before the super pit halves kind of sold in rapid succession.
In between the two.
Wow. So like that was the opportunity cost in some respects. Like I know the upfront price maybe wasn't as comparable, but like in the fullness of time, the amount of capital that they've put in and the additional bolt-on acquisition they've put more capital to work than would have been required for a half of the super pit. I think that's the opportunity cost that may have been missed, and I'm sure they're awake to that. And it's rich of me to say and be critical of, but yeah, like, you know, we're not perfect, even if we've got like many runs on the board from a capital allocation perspective. I think that's like a reflection I have.
Yeah, I would totally agree. And my last two, they might be a bit sort of philosophical, but I think that thinking about like the toughest time for the business is also the best time. So 2014 to 2015, you heard all the costs they were cutting out of the business and all these sorts of things, but the deals they did led to the growth of the company. There's something kind of in that. And lastly, good things just take a long time. We spoke about the amount of times you could look and take a multi-year snapshot of the share price and it would be down or it would be flat-ish. But if you zoom out long enough, it's an incredible value creation story. And I think that just hammers home the fact that, you know, you keep compounding, you keep working at things over a long time and it sort of pays off, but you need to be patient. It takes a lot of patience.
Yeah, it's a story of deals. There's like a point there on, like, you know, you bring up that slide with all of the peers, and a lot of those peers like disappeared or fell over from like far more erroneous capital allocation than Red Lake proved to be the fullness of time. I don't think like I can understate how appreciative I am of capital allocation of gold miners. This is the thing that differentiates gold miners from each other, is how you allocate capital. And I think like what is Evolution as a company? Like they get capital allocation right 99% of the time. Like these are remarkably good capital allocators. They're like thoughtful, nimble deal makers, and they take the responsibility like serious. It's a safe set of hands. They're insanely backable. I wonder if you thought much about that perception of them as you've like put this work together, JD.
I think like a safe pair of hands is a kind of great way that what you mentioned before, the institutional investors, in particular, perhaps the generalists would kind of call them a safe pair of hands. They're reliable. And again, a bit of a cliche, but like we say we do deliver, we deliver, that type of thing, which they've said for a long time. And the consistency comes back to the strategy as well, which hasn't changed throughout. And yeah, you can't say the same for a heap of miners out there. So I couldn't agree more with what you've kind of put together and the bow you kind of put it on it there. It is a remarkable story to think about, to learn about, to understand. And yeah, hopefully there's more than a few sort of nuggets in there for people to glean from.
I've got some more questions for you, unprompted, mate. How do you think Evolution like differed from Northern Star?
I mean, firstly, the stories kind of track themselves. In particular, once the story gets going at Northern Star, Evolution took an asset that was more mature. They took a producing asset that wasn't going to shut down in 7 months' time like Paulson's was. So once that quick share price appreciation is done at Northern Star, there's a lot more of a closer tracking between the two. Jundee, maybe the best deal ever. Like that is one of the takeaways you kind of got to have. Like $82.5 million for that. It's just astounding. As good as all these deals that we've spoken about are.
We've just spent 2 hours talking up the deal making now of Evolution, but Jundee is still a far better deal than Evos could pull off.
I still kind of scratch my head at that one. And yeah, I mean, I coming into it had always thought, you know, Evolution, like the deal makers, Northern Star, particularly because of that early period with the geos and what they had to do to kick out the life. But, you know, these two stories are far more alike than they are different.
Balance sheet. Do you think like, yeah, I know Evos have a, you know, their own target net debt range or gearing range and the likes. At times, their share price has been quite volatile because of debt in the cap structure. Do you have any reflections or thoughts about gearing?
Super good question. Like, so they talk about that 15% gearing, and I've reflected like a bunch on this because I've always come from a position that like it's kind of terrifying. And we saw on the other hand with the Fortescue story, yeah, when it goes well, boy, does it go well. But If you have a portfolio of 6 to 8 assets that operate in the better half of the cost curve, then I think 15% is pretty prudent. I'm a fan of the strategy of taking on a bit of a debt if you have the confidence that within like 2 years you can hammer that down. Like there is a bit of risk to it, but that amplifies the return quite a bit. And I think they're very sort of thoughtful with that. But again, you know, they'll often say like single asset producers are far too risky. They will say that, and they will, after you know almost all, I think all their deals, they would hedge in, they would lock in a bit to minimise the gold price falling away risk. So I think there is room for that, and we see that more at the bigger end of miners, which we don't speak quite often about, being a bit more sort of thoughtful given where they sit in the cost curve with their assets.
The part of that marketing piece is the dividend predictability as well. Even in the bad years, they'll pay a pretty marginal dividend. But the marketing piece, like, I wonder what impact that actually has to their multiple. I think it's a bit. I think they get a fair bit of a multiple re-rate purely based on how marketable they are. Like, I've spoken to a bunch of different people over many years. I always like ask people like, does Evolution's valuation make sense? Right? And yes, gold price keeps going up, and so Evolution share price keeps going up. But everyone always says no. A lot of people think that Evo's commands a premium in the market that is not at all that is like sufficiently larger than what the real value of what their assets might be, especially compared to other people, other comparable companies. And part of that's like just that marketing factor. And this company is so large that it is in enormous indexes.
I've always thought the same. More so in the last few years, and that has been tainted by that period of heavy investment. So like, a lot of money was spent in 22, 23 into 24, and obviously like the change in cash on the books didn't look that great through that period because they were investing so heavily in the assets. So very keen to see what that looks like in the next few years.
I want to put like a couple of questions to you as well, mate, just in relation to, I suppose, like, firstly, Evolution, the company, like what do you think is next for them? In some ways, I ask you that because the story that Jake tells with Sino Gold is the next phase of growth for Sino Gold was not actually them embarking on more growth. It was to combine with another company. Sometimes a deal is the phase of growth. Like, Jake's stepping down from an executive position into a non-exec and embarking on a new adventure in a smaller company.
Yeah. I mean, from Jake sort of stepping down, I think growing a smaller company is just more exciting. But the bigger question about where does Evolution go from here is a really interesting one. Because where do you kind of go? Obviously, you can continue to improve the portfolio on paper. That makes a whole lot of sense. How do you actually do that? The best answer I've kind of got is like looking back in time, looking 10 years back, you wait for your opposition to trip themselves up. Like, if you can make good cash when times are really, really good and just wait for the bad times, you don't know what opportunities are going to present themselves. But as we sit here today, when everything looks very expensive, it's pretty hard to think, like, where do they go from here? So remember how different that landscape looked 12 years ago when we looked at all the companies around? What's it going to look like in 10 years? Like, that comes down to how you manage yourself in the good times. You set the table in the good times to what's going to follow. We've spoken about this with companies taking measly amounts of debt when things are really good, and all of a sudden that amount of debt looks enormous when the tide turns very quickly. So who knows what opportunities will present themselves if you just remain disciplined in the good times. What do you think?
I think, like, even though, transitions happening with Jake, Evo still has great consistency of personnel. There's, like Laurie's been there for a very long time, and has like tremendous buy-in from his employees. Yeah, you've still got Kieran in the BD team. There's there has been some change, but like there's still great consistency there. I don't think you'll have like massive deviation from the strategy. And I think like the party line has been, in the good times, we're more likely to be sellers than we are buyers. Like I actually believe them on that. Like I wouldn't be surprised to see them potentially rationalize certain assets in these good times. Like I think of the likes of if you get a great offer for Red Lake, do you sell it? Or if you get a great offer for Mungari, do you sell it? I think the answer to that is you probably do. I wouldn't be surprised to see them like incrementally continue to add more like copper. And why do I say that? Because in what work, like if the next phase of growth for Evos is unclear because they've already got the right number of mines that they've always said they would have, and they trade at such a premium that like it never makes sense for them to get acquired at a premium. Do you know what I mean? Like if you trade at a premium to everyone else, no one's doing a deal to buy you at a premium because it's not an accretive deal. You can't sell that to shareholders. So, but adding more copper kind of does. Everyone wants more copper. Everyone wants I think you attract a high premium, and you can backfill that with more copper. In the very long run, I think it's a merger of equals with a peer. I think like one of the Canadian miners, where scale becomes increasingly important. Yeah, Agnico's become like enormous, like as they already are. Maybe Barrick and Newmont merge. So where does that leave the tier below that? I think you might have a merger of equals. That's my prediction, completely unfounded and not substantiated by anyone other than my own like thoughts. But yeah, I think the next phase of growth is actually similar to what Sino Gold was when they actually had to sell themselves to Eldorado.
I think that's a good take.
What do you think of like Jake's? Yeah, like so his now new vehicle is Federation Mining. Endura renamed. This was an Aussie Super kind of backed vehicle. I'm sure it'll make its way to public markets at some point, but do you just apply a cookie cutter evolution playbook to that vehicle and expect that's what will happen next?
Well, it's kind of funny, right? Because Conquest was also started in a period of a bull gold market, which we're clearly in today. You're going to have to be a bit patient if you want to find kind of forced sellers around there, but they've got a bunch of work to do in the meantime, and they're going to have no shortage of people giving them money. So let's kind of see. Are they going to do something massively different to what Jake has kind of done in the past? I find that hard to believe. But yeah, it's all about the timing and how these things sort of present themselves, the deals that present themselves. Are there maybe slightly different jurisdictions they could play in, perhaps? I mean, New Zealand already is slightly different, although Evolution did look there and do a bit of exploration there back in the day. But it's a tough one. How do you think about that?
I think it's the same playbook that will pan out in time. What you have is like a serially successful person, phenomenal access to capital. There's an opportunity, and that's one common theme is like Evolution can see the opportunity. I think it'll be a story of deals to come there. I'm excited to see what deals can kind of be manufactured in a new vehicle, but I've got no doubt that's what will happen.
Commodities are cyclical, and I've no doubt we're going to see another cycle in the gold market sooner or later.
Another cycle? What do you mean, mate? You're predicting the end of this one?
It's right when things are so good that you don't think they're going to go bad when things turn. So let's see what happens there.
100%, mate. Well, thank you for your research, and thanks for telling the story. I love it. I know a lot of other people love it. Get some great feedback from the work you've done on these, mate. It's
Mate, appreciate you putting up with it. It was a long sort of story to tell, but yeah, hopefully the listeners got a bit of value out of it because the research was super fun to do, and I think it's a story worth telling.
100%. Hootaroo.
Hootaroo! And a huge thanks to our great partners, mate. Sandvik Ground Support, Focus, the platform by Market Tech, and Intralinks. Check them out.
Hootaroo.
Hootaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.